In 1996, there were a total of 739 IPOs in the US. But last year, there were only about 225. Companies are going public at a fraction of the rate that they were decades ago, and in a strange twist, some public companies are even being taken private. In fact, 30 years ago, there were over 8,000 publicly traded companies in the US, but now that number is hovering at around 4,000. Half. So why aren't companies going public anymore? What does this mean for investors and regular people? And why are economists so worried? Well, let's find out together, shall we? So, to start off, why would a company want to go public in the first place? Well, imagine you're a talented mechanic, and you've started a small company that makes car seats and sells them to a local luxury car manufacturer. It's a good business because you know how to make them, you can charge high prices, and they're not too expensive to make. But behind the scenes, you've been designing a new kind of car engine, and you think the customers will really love it. The problem is, building car engines is very expensive, more expensive than building car seats. You need to buy raw materials, specialized machines, more factory space, and hire some new people as well. And even though business is going all right, you don't have the money to make that kind of investment out of pocket. So you go to the richest friend you've got and you tell them, hey, I'll give you 10% of my company if you give me the money I need to do this big thing. It's a good idea, so they decide to invest. You go ahead and start making engines, and they sell like hotcakes. In fact, you even land a few new clients, the likes of Ford and Volkswagen, so you're making serious money now. One day, though, you think to yourself, we've gotten really good at making these engines, and that's great, but there's really no reason why we couldn't build the drive shaft, or the tires, or the whole body of the car. We should start making our own cars. It's an exciting idea, but once again, even though the business is booming, it's not booming so much that you can just build a whole manufacturing plant and hire hundreds of people to boot. Even if you gathered all of your rich friends together, they don't even have that much money. So this is when you decide that it's time to take your company public. And that's when you have an initial public offering, or IPO. So basically, an IPO is a company's first sale of stock to public investors. And here's how that typically works, okay? Every company is made up of shares, tiny slices of the company that people own. In an IPO, you typically create a bunch of new shares and sell those to the general public to raise as much money as you can. But how do you know what the right price for those shares is? Well, when a company decides to go public, the first thing it does is pick an underwriter. This is a bank that helps the company figure out if it's ready, how much money to raise, how many new shares to create, and a realistic price range for them. Now, selling a few shares means that everyone's slice of the pie gets a little bit thinner, but in exchange, the company gets a lot more cash to work with. The night before trading starts, shares are allocated, which usually means large institutions like pension funds and mutual funds get a chance to buy shares at the IPO price. That money goes straight to the company, and the next morning, regular investors can buy and sell the company's stock like any other. From then on, the company basically lives in public. It has to post quarterly results, answer analyst questions, and deal with the press. So, why go through all of that? Well, because the upside, it can be pretty huge. First of all, selling shares to the public opens up the door to pools of money that just don't exist in private fundraising. That influx can pay for new factories, product lines, research and development, acquisitions, you name it. Secondly, going public finally gives founders, early employees, and early investors a clear path to turn some of their paper gains into real cash, either at the IPO or gradually over time. Thirdly, a public listing comes with audited numbers, regular disclosures, and a visible market price, which builds trust with customers, partners, and potential hires. And it lets the company use stock as currency to buy other businesses or reward talent. And fourth, instead of relying on only a handful of backers, the shareholder base spreads across thousands of investors, which can make the company more stable and less dependent on any one person's checkbook. That's the basic idea of it all. Now, going public is the moment when a company stops passing the hat among a few wealthy friends and opens up the door for everyone else to invest. You're trading a bit of control and a bit of privacy for the resources and credibility to play on a much bigger stage. So that is why companies typically go public. But recently that has been changing. Take a look at this chart, for example. It shows the total yearly IPOs from around 1986 to 2024. And as you can see, with some spikes here and there, there's a clear downtrend, which is kind of weird. Back in the 80s and 90s, having an IPO was basically the ultimate milestone for a company. Today, though, the US has fewer publicly traded companies than at any other time since the 1980s. And on average, companies are waiting a lot longer before they IPO, even the ones that are massively successful. And this is, well, it's kind of unprecedented. A generation ago, any startup that reached a $1 billion valuation was virtually guaranteed to IPO, but today, that is no longer the case. Uber, for example, was founded in 2009 and grew to a valuation of over $60 billion before it finally IPO'd in 2019, nearly a decade later. Airbnb was founded in 2008. It reached 100 million users in 2016, but it didn't go public until 2020, 12 years after launch. Some companies, no matter how successful, have simply decided to stay private. For example, Stripe, a payments company founded in 2010, was recently valued at just over $100 billion, but as of 2025, they seemingly have no plans for an IPO at all. And SpaceX, which, with a valuation of over $400 billion, is the world's most valuable private company, it is staying private as well. In the case of Uber and Airbnb, where it took them over a decade to IPO, it's pretty unprecedented. But with companies as successful as Stripe and SpaceX, it has never been seen before. Elon Musk has even said he's not going to consider taking SpaceX public until they literally establish a working colony on Mars. So there's that. And we've also seen a massive rise in previously public companies being bought out and being taken private. Remember Twitter? But why is the IPO seemingly going out of fashion? Well, it turns out there are 4 major reasons for this shift, and the more you look into them, the scarier things get. Now, if you're watching this video, chances are you're the kind of person who actually cares about wealth, success, and building a better life for yourself. And here at Alux, that is literally what we're all about. And it's why we built the Alux App, okay? A tool designed to teach you about wealth creation and actually help you to put those lessons into action. Inside the app, you'll find daily lessons on money and wealth creation, but you'll also get access to full courses from industry experts on topics like entrepreneurship, personal branding, even building confidence in your relationships. The kind of skills that actually move the needle forward in your real life. And to make sure you make some real progress, we've built a whole suite of tools for you to set your clear goals, track your progress, and stay accountable, so you're not just taking in more information, but you're truly building the habits that lead to long-term success. And to sweeten the deal, you can scan that QR code on screen or click the top link in the description of this video to download the app and get 25% off your yearly plan. Because at the end of the day, the best investment you will ever make will always be in yourself, okay? All right, with all that said, let's get back to the topic at hand. So, why are companies staying private? Well, like we said, there are 4 main reasons why companies are choosing to stay private for longer, or in some cases, forever. The first one, and this one you can probably already imagine, is the rise of private money. So in the 1980s or 90s, if you were a tech startup looking to raise $100 million to fund your next growth stage, you basically had no other option than to IPO. But in the last few decades, there's been an explosion of private funding sources. Venture capital firms raise billions from wealthy investors and institutions to invest in startups. Private equity firms raise even bigger funds to buy and grow companies without ever taking them public. Sovereign wealth funds, which are basically giant national investment accounts from countries like Saudi Arabia, Singapore, or Norway, also pour billions into private companies. And then you've got hedge funds and private credit providers lending or investing on top of that. In plain English, What this means is that there are now huge pools of money floating around outside of the stock market. Put all of that together, and today's founders, well, they don't need to go public anymore. They can raise as much money as they need, and often more, without ever ringing a bell on Wall Street. The result is that companies can delay their IPO for years or sometimes indefinitely. Back in 1980, the median age of a company at IPO was just 6 years. But by 2021, the median age was more like 11 years. In other words, companies are now about twice as old and generally far larger by the time they go public. Now, the second reason is regulation and compliance. So in the early 2000s, after corporate scandals like Enron and WorldCom, US Congress introduced a bunch of changes that were meant to restore trust in public companies, and in many ways, they did. They forced CEOs and CFOs to personally sign off on their numbers and required companies to run internal audits to prove their books were clean. Those changes improved transparency, but they also made being a public company far more expensive, especially for smaller firms. Being a public company can cost millions of dollars a year just to keep up with the paperwork, audits, and disclosures that the government requires. You also need to maintain a formal board structure, deal with investor relations, and disclose major events almost immediately. And not to mention the complicated process of even going public in the first place. It adds up to a lot of scrutiny and bureaucracy, and some founders look at all of that and they just say, ugh, why bother? If private investors are willing to hand them the money they need, well, staying private is often a much simpler choice. Then there's the third reason, and that's what a lot of CEOs call short-termism. You see, once you're a public company, you don't just answer to your customers or your employees. No, you answer to Wall Street, and Wall Street runs on a 90-day clock. Every quarter, you have to report your earnings, and if you miss your targets by even a penny, the stock can tank. If a CEO says something slightly negative on a call, it can turn into front-page news, and the share price can lose billions of dollars in a single afternoon. Netflix, for example, lost more than 20% of its market value in just one day after reporting fewer subscribers than analysts expected. That kind of volatility can be exhausting to deal with, and it can also lead to bad decision-making because it pressures the company leadership to think in terms of the next 3 months instead of the next 3 or 30 years. Maybe you want to invest heavily in a new product or a risky innovation that could be your next breakthrough. But if that investment means you'll miss your earnings this quarter, well, you might hold back. And it's not just about earnings. Public companies also have to deal with activist investors, hedge funds that buy up huge amounts of shares and then push management to make changes, like cutting costs, spinning off divisions, or selling the company entirely. And that's why many founders are choosing to stay private for as long as possible. Going public puts you on a treadmill of quarterly scrutiny, and once you step on, it is hard to step off. But staying private means you can be more patient without Wall Street's constant judgment. And then there's the fourth reason. It is mergers and acquisitions. Now, this one doesn't get talked about quite as much, but it's still a big piece of the puzzle. A lot of the companies that might have gone public in the past are simply getting bought out before they ever reach that stage. In tech especially, the big guys like Google, Apple, and Meta have made a habit of scooping up startups before they IPO, not just to gain talent or new technology, but also to prevent rivals from rising up. Facebook famously tried to buy Snapchat in 2013 for $3 billion, partly to stop it from becoming a competitor. They didn't sell, but Instagram did. Private equity firms have also played a huge role in this, buying up companies that might have otherwise gone public, keeping them private, and then reselling them later. For some startup founders, this is the strategy from day one. Instead of building a company to go public from the start, the goal is to get a big fat buyout offer from a bigger fish. So, mainly for all of these reasons we've talked about, we're seeing a consistent decline in the number of companies deciding to go public. But, okay, who cares? Does this have any real impact? Well, it turns out Yes, it actually is a pretty big concern for some economists. Because you see, economists and regulators worry that when companies stay private for longer, regular people miss out on the chance to invest in the early growth stages of a business, where the biggest gains often happen. Instead, those gains go almost entirely to private investors who were already wealthy to begin with. Over time, that could mean the stock market offers fewer high-growth opportunities for everyday people, and more of the wealth created by innovation gets concentrated in the hands of a smaller group of private investors. In terms of the pesky new regulations that are discouraging companies from going public, well, they also exist for a reason. Regulations protect investors, keep consumers safe, and help to prevent the kind of fraud and collapse that destroyed companies like Enron and wiped billions of dollars in value from the economy. When massive companies that affect millions of people's lives remain private, they don't face the same level of oversight, so their problems can stay hidden for longer, sometimes until it's too late. Just look at what happened with FTX and Sam Bankman-Fried. And when it comes to mergers and acquisitions, look what just happened with Adobe and Figma. Adobe has a pretty long history of buying up competitors and basically just killing their products so it can stay as the dominant player in creative software and charge ridiculous prices. In 2022, they tried to acquire Figma for $20 billion, but regulators blocked the deal. Fast forward to today, Figma has gone public at a valuation that is higher than Adobe's offer. That means that more value has been created, and now the two companies are competing head-to-head, which means more innovation for users. And that's exactly the concern. When more and more companies get absorbed into giants, you end up with less competition, less innovation, and more power concentrated in just a few hands. That might be good for the Adobes of the world, but it can leave consumers with fewer real choices. So, where does all of this leave us? Well, IPOs are not extinct, but they've definitely changed. The US still has the deepest capital markets in the world, but companies are tapping into them differently than before. For decades, going public was the way a company got big. Today, most companies only go public once they're already big. On the one hand, regular investors get fewer chances to ride the early growth wave. Companies face less scrutiny when they stay private, and entire industries risk becoming dominated by a handful of giants. But at the same time, private markets have unlocked massive amounts of capital and given founders more freedom to grow on their own terms. So, our question for you, Aluxer, is this a good thing or a bad thing? And what do you think happens next? Will IPOs make a comeback, or are we just going to see fewer and fewer of them over time? We can't really predict the future, but what we do know is that the way companies grow and the way we invest in them is being rewritten right now. Alrighty, Alexer, thanks for spending some time with us today. Make sure to like this video if you found it insightful, and remember to join us inside the Alux app by scanning the QR code on screen or clicking the top link in the description of this video. If you want to learn the biggest economic problems that we're facing, you can click this thumbnail on screen to watch this video next. We'll see you back here next time, Alexer. Until then, take care.